Greg, what do you make of what happened today with Williams? Did he need to clean something up from what Powell said on Wednesday?
The main reason the market was disappointed with Powell on Wednesday is they were hoping for two things. They were hoping for a lot of emphasis on data dependency and open-endedness in terms of the Fed's plans. And I think some were even hoping for like a one-and-done announcement, basically saying we've stopped raising rates. The second one, they were never going to get the one-and-done message, but they probably were hoping for a bit more emphasis that the Fed was not wedded to the 2 rate increases next year. And that's kind of what Williams did today. He kind of went back and he underlined those parts of the message that Powell failed to emphasize adequately, that, you know, we have our eyes wide open, we'll change as needed, adjust as needed, it's data dependent, the forecast has to come true. The fact that the market still melted down after a brief bump up tells me that this really isn't an issue of how the Fed communicated what it's doing. There's something else going on here, and I have a base case and a sort of like a sort of more scared case that I can talk about later on, but that's my basic call on that.
All right, good tease there, Lakshman.
Yep.
Is the Fed missing signs of slowdown in the economy?
Yeah, absolutely.
Is that what this is about?
Well, you know, their eyes are wide open, but they're kind of staring at the stars, this R star and U star, which kind of guide their policy, even
Models.
though they talk about, you know, data dependent. That's still how is it going to impact those models. That's out of step with reality, right? Which is that growth is decelerating and that inflation, separate inflation cycle has turned over. We called that back in the summer. If you look, that's no longer a forecast, it's a fact. PCE inflation is at a 10-month low, having peaked in July. It's below now the Fed target at 1.8%. And I think Powell struggled with those questions in the Q&A a bit about what's going on with inflation and had to kind of bob and weave around that. The market is saying very clearly there's something up. It may be a lot of uncertainty around government shutdown, trade war, tweeting, resignations, all of these kind of idiosyncratic things. But one thing that is pretty clear, at least from our work on cycles, cycle risk is not idiosyncratic. It's kind of knowable, it's measurable, it's what we do. The cycle is down. And I think that part of the story is crystal clear, actually.
Greg, you gave us the big tease earlier. What's the play here?
So I think the base case here is that this is a bull market that for the last decade has benefited from this just astonishing three-front wave of monetary ease. They've had zero rates, they've had quantitative easing, they've had forward guidance saying rates aren't going to go up. One by one, all those things have been taken away. I think this was the week when they realized no more hand-holding from the Fed. That means normal monetary policy for normal times, and that should means normal volatility. Stocks have got to adjust to the fact that it's the riskier world out there. I think that is my base case about what's going on here. The part that I'm a little bit worried about, though, is as follows. What if it's the case that the 3% growth that we had in the last 12 months was a head fake? We got a sugar rush from fiscal stimulus, some good luck on commodities, and it turns out that this really is kind of a secular stagnant kind of economy that can't really grow more than 1.5%, 2%, and it can't tolerate real interest rates of much more than zero. I mean, it seems ridiculous that a federal funds rate of 2%, which is zero in real terms, could pull this economy down. But that's kind of what we've seen in Japan and other places where these really sort of dampening forces take hold. If that's the case, the Fed has to really readjust what they think a so-called neutral rate is and confront the possibility that this economy has taken all the monetary tightening it can stand.